Hello, everybody. Ignatius Jackson, CPA here with an awesome video for you. We're coming back. We're coming back. I'm sorry I went away for a little while, but hey, we're back with some cool stuff. Today, we're going to talk about wealth taxes. How much do the rich pay? Is there any way to not pay any taxes at all? We're going to touch on some of that stuff. It's a pretty cool topic. I'm sure you've heard of this article that came out recently. We're going to dive into it a little bit, explain some things to you. Give you some knowledge, and then talk about some other cool stuff. So just go ahead and stick around. We'll be right back in a second. All right, everybody, and we're back. So today we're talking about how much in taxes the wealthy pay. Okay, so I'm sure you've heard, there was an article recently that came out by ProPublica that talked about primarily for wealthy taxpayers that are out there and how much they're paying in taxes. Warren Buffett, Jeff Bezos, Michael Bloomberg, and Elon Musk were the four that are kind of on this table that I'm going to go through here in a second. And ultimately, the moral of the story is, if you look at these numbers, okay, which I adamantly disagree with how they're analyzing this, to be perfectly honest. Some of the stuff that you're hearing out there about how much the wealthy pay, okay, they're talking about taxing their wealth, basically taxing their unrealized gains, and because they're making smart investments and things of that nature. And they're talking about taxing that stuff more than what they're currently taxing it. I don't necessarily agree with a lot of it. I think there are certain things that we could change, that make sense to potentially change, but there's a lot of things that don't make a lot of sense. And there's some things in this article that I definitely don't agree with. And so we're going to go into it. We're going to dive into it. We're going to talk through it. And I'm curious to see what feedback you guys have. So by all means, leave a comment, leave me a message, all that great stuff. Very interested to kind of know what your thoughts are on the article and just kind of in relation to wealth taxes in general. Okay, so what I want to do first and foremost is maybe just pull up this publication, this article, just so you guys can kind of see this. I'm not making this stuff up. This is what they have. Now, I will caveat this with, we have not actually seen a copy of their tax returns. Okay, so because we don't actually have a copy of the tax returns, it's hard for us to know exactly what it is that they're paying, and how they're saving on their taxes and why it makes sense. But based on the numbers that are in this article, we're going to give you some of our thoughts and let you know what we think. Okay, so here's the article. Okay, ProPublica, like I said, you can go there. The name of the article is this: the secret IRS files trove of never before seen records reveal how the wealthiest avoid income tax. Okay, so here's the table that they put out there. Over a 5-year period from 2014 to 2018, here's how much in taxes that these four individuals paid. Okay, let's go column by column. Let's go column by column here. Wealth growth. What does that mean? To me, that means unrealized gains on their investments and ownership of entities like Berkshire Hathaway for Warren Buffett, Amazon for Jeff Bezos, Bloomberg for Michael Bloomberg, and Tesla for Elon Musk. Okay, so all these guys are executives for these companies, meaning they get paid in stock compensation typically, or through dividends, or through some other method of earning wealth. And sometimes, with the exception of dividends, those items are not going to be realized until you actually sell the stock. Okay, so you're not going to get really taxed on a lot of that stuff until you actually sell it based on the growth of that item. So to me, that's what the wealth growth is. From all their investments and all their activities, how much their wealth grew during that time period. And I don't know that they know for sure that that's how much their wealth grew. They're probably using some kind of methodology like the Forbes 500 list or something like that to kind of indicate how much their wealth grew. But ultimately, That's where they come up with that number. The total income reported, okay? This I assume is from their tax returns that they somehow got, and that's a whole nother story on how they got the tax returns, just like how they got Trump's tax returns. I mean, these all tax returns are supposed to be confidential unless someone wants you to see that, okay? We shouldn't be forced to show any tax returns to the public. And so but all of a sudden there come out some kind of investigation because we had these 4 guys who had their tax returns leaked somehow from the IRS, it appears. Okay. Again, I'm not going to get too much into that because no one knows exactly what it was yet. So we're just going to leave it at that. Okay. But ultimately, total income reported is the next column. Total taxes paid is that next column. It means exactly what that is. Total taxes paid. Total income reported, exactly what that means. Okay. And then true tax rate. So the true tax rate, how they're coming up with that is by taking the total taxes paid and dividing that by the wealth growth. That is the number that I absolutely disagree with. Okay. I understand they're using the word true tax rate. I don't agree with that. I think it's crap. I think it's a load of BS. I just don't agree with it. Okay. No one in the tax world who actually does taxes, a professional, would think about taxes in that manner. Okay. We get taxed on our income. It's called income taxes for a reason. You get taxed on your income. Okay. And income is basically going to be items that you realize. So, meaning if you have an investment that you made and that investment grows in value, just like if you owned a business, just like if you owned some stock and it grew in value, okay, you don't want to get taxed on something that you never received a dime from. It's just common sense. You should be receiving money before you actually get taxed on it. That is the general way that our tax system works. The tax system doesn't necessarily work on an accrual basis. It usually works on a cash basis. Now, certain companies, yes, they do report their stuff on an accrual basis, but for the most part, taxes are done on a cash basis for individuals. And we're talking about the individual's tax returns here. So from that perspective, it should be based on a cash basis, meaning if they receive the money, they pay taxes on any income that they received. Okay. It makes total sense to do it that way. But for some reason, they're sitting here trying to say total taxes paid and comparing that to their wealth growth, which includes unrealized growth in income. Okay. It's just crap to me. All right. The more appropriate way to do this calculation, okay, I'm just going to pull up a calculator here. All right, is to take their total taxes paid. So in the case of Buffett, we're going to say 23.7 million and divide that by their total income. Bam, that's an effective tax rate, essentially. Okay. Now, total income reported, I'm not too sure if it's gross income, adjusted gross income, taxable income, etc. I didn't read too far into the details to find out if that's what that is or not. But long story short, I mean, assuming that this is taxable income, basically, total taxes paid compared to total income reported, 19% is what Warren Buffett's paying. That's pretty high. I mean, on an effective rate basis, that's fairly high. I mean, they're paid $23 million. I think the common misconception that I hear from clients is that wealthy people don't pay taxes. Well, this shows you that that's crap. These are some of the most wealthy people in the country, and look at how much money they're paying in taxes. Okay. I mean, I don't know how else to put to you. I mean, I get this comment all the time from people. Oh, I don't want to pay taxes like Bezos or like Trump or like Buffett or whatever. Okay. Trump is probably a little bit of a interesting story because of the fact that he has real estate activities and some other stuff. He's a real estate professional. That's a certain exception under the tax code that allows you to take some pretty hefty losses against other income, et cetera, et cetera. That's a whole nother ball of wax. But as you can see, these 4 individuals are definitely paying taxes. Okay. And so, 19% effective tax rate. Let's look at Bezos. That's a 23% effective tax rate. Again, do the same calculation. Take the 973 million, divide that by the 4.22 billion, comes out to 23%. Okay. Bloomberg probably is paying the lowest effective tax rate, which is 3%. That's actually pretty surprising. I'm not exactly sure what he has going on. So from that perspective, this probably is not taxable income, given that he's paying as little as he is. He likely has some other items that are deductions and things like that. He might be doing a lot of itemized deductions, taking away some charitable contributions, stuff like that, to lower his taxable income, because 3% is actually pretty low. All right, that one's pretty darn low. Musk, 30%. Musk is probably doing the worst out of all of them, it looks like. 30%. So total income reported, 30% of that income he's paying taxes on. So I guess ultimately the moral of the story is take this article with a grain of salt, okay? When you look at these true tax rates, I wish they would have put another column in here that said effective tax rate, because frankly, that would be a more accurate depiction of how much in taxes these guys are actually paying. And it really sucks because we just don't have enough information to be able to calculate exactly what that is. So these numbers that I gave you are kind of estimates. Without seeing the actual tax return, I can't give you the actual factual effective tax rate. This is just my best guess or kind of assumptions at doing that. But ultimately, this is something that I think is pretty darn essential, and something that, we should definitely consider when we're talking about raising taxes on people. Okay. These guys are already paying a decent amount. I mean, frankly, I don't think this stuff should be taxed. I don't think the wealth growth that someone is accumulating should be taxed. It just doesn't make conceptual sense. Again, if you think about it, they haven't received the money. Okay. So why would we want to tax someone on money that they haven't received? It just doesn't make logical sense. And so this actually is a little bit irritating that they're doing it this way, but it is what it is. So hopefully, people kind of take a little step back, actually understand the nuts and bolts of this, and understand that the moral of the story to me is wealthy people do pay taxes. Okay. It's not like they're not paying any taxes at all. They're paying millions of dollars in taxes. All right. Bezos paid almost $1 billion in taxes, for crying out loud. All right. So they're definitely paying, you could argue whether it's their fair share or not, but they're paying a decent amount of their income. I mean, most of us that are lower income, making less than $1 million a year in income, right? Most of us pay a rate of about, 20%, 25% in effective tax rate, somewhere in that range. That's just the way that, it kind of works out. And so it seems to me, as if you look at it from that perspective, that they are paying close to their fair share, maybe a little bit lower, but it seems like they're paying their fair share. Now, what's the moral of the story here? Make sure you invest wisely, okay? If you're investing in good stuff that is growing for you and not being taxed, that's the way you should be doing it. See, instead of going after the rich for doing stuff, why don't we do more of that ourselves and do those smart investments ourselves and have that growth ourselves that is ultimately building our wealth and is not being taxed? If you hate paying taxes, start putting stuff into good vehicles like stocks and buying companies and investing in businesses and things like that. That's where the wealth accumulation really comes from. And when it comes down to it, that's what you have to really think about. They're still paying taxes, okay? If you own a business, if you have a W-2 job, if you have other income from dividends and stuff like that, you're going to ultimately pay some taxes. The key is, once you pay those taxes, what are you going to do with it? And I talked a lot about this during Financial Literacy Month. If you go back to my series, I talked a lot about this. What are you going to do with that money once you actually earn it and you pay some taxes on it, to invest it wisely so that you don't have to continue paying taxes on money that you're earning every single year? Okay. If you don't waste it on frivolous things and you actually put it into something that's worthwhile and that's a good investment and that's going to bring you some good returns, then you're going to pay less in taxes. And mind you, dividends are not that bad, by the way, unless they try to change this rule. Dividends are taxed at the long-term capital gains rates when they're from a corporation and you've held it for at least 60 days, okay? Dividends are taxed at the long-term capital gains rates, okay? So is that a bad thing to have? No, I think that's actually a great thing to have. it's better if it's inside of a retirement account, because then you don't pay any taxes at all until you reach retirement age. And if it's in a pre-tax account, you'd pay some taxes. But like we talked about in some other webinars and videos, it's definitely beneficial to have Roth accounts where you don't have to pay taxes in the future. So if you have those dividend earning accounts, even if it's in a taxable account, that's still good income because you're paying lower rates. Okay. It's just automatic. As a dividend, qualified dividend is what it's called, a qualified dividend. If you have those qualified dividends coming to you, you're going to pay a low rate depending on what your income is. And so ultimately, investing the money wisely, having that appreciation, that unrealized gains, same thing with your house that you might live in, or rental properties that you might own. All those items are appreciating assets. Stocks, appreciating assets. Houses, mortgages, not mortgages, excuse me, but houses, condos, appreciating assets are good investments because you get that unrealized income gain that does not end up getting taxed until you actually sell it and you realize that income. That means you got money coming into you. When you have money coming into you, then that means you should pay taxes on that income, right? Okay, common sense. So from that perspective, I don't agree with what they're trying to do here with this article, as I mentioned previously. I'm really curious to see what everybody else thinks. By all means, please leave me a note. Let me know your thoughts, leave a comment, all that good stuff. I typically respond to most comments, so by all means do that. And we're gonna see what comes from this. So it'd be interesting to see how these items got leaked, and really how many others they might have actually received. These are the 4 they talked about in this article and in this table here. I'm sure they got others. So and so yeah, it's just, I don't know. This is just something that I read recently that I was like, you know what? Let me get back into my videos and let's talk about this a little bit. Let's throw this around and let's kind of see what's going on here. So hopefully you enjoyed this. It was enlightening. But keep in mind, again, rich people pay taxes. Wealthy people, however you want to call it, they pay taxes. Okay. If you're looking for some way to not pay any taxes, good luck. Eventually, you're probably going to get caught. Not my problem. It is what it is. I know if you're my clients, we don't do anything super crazy or frivolous or anything like that. But, be careful of anybody out there who is, and there's people going to jail all the time who are coming up with stuff that is too good to be true. If it's too good to be true, you probably should be questioning it. You might want to get a second opinion because chances are there's some stuff going on there. The goal is to reduce your effective tax rate as much as possible, but it's never going to be zero unless you're really low income. Okay, if you're really low income, you qualify for earned income tax credits and child tax credits and all this other stuff, then yes, your effective tax rate could very well be zero, or in some cases negative, because you end up getting paid money instead of having to pay money in because of the various tax credits that are out there. Okay, so that's totally possible. But most people are paying some amount of taxes, and your effective tax rate is going to be something. Okay, the goal is to just reduce it as much as possible. Anyways, long story short, thank you for listening in. Hope everybody enjoyed. We'll talk to you later. More videos to come. We're also going to do a live video here in the next week or so announcing the raffle winners from Financial Literacy Month. Apologize for the delay on that. We've just been really busy doing some stuff. But we're going to have that coming out here shortly and get back into recording some videos for you. All right. Hope everybody has a good day. Bye-bye.